Ever heard of creative financing? It's how some investors swing those acquisitions that make you wonder, did they find a pot of gold? We're talking billion-dollar deals, ones that seem impossible.
Oh, it's not about magic.
Yeah.
It's way more interesting than that.
Okay, tell me more.
It's about strategy.
Okay.
These days, it's not just about deep pockets.
Right.
Think of it like chess, not checkers.
Oh, I like that.
Smart investors use creative financing to outmaneuver the competition. Snag those golden opportunities.
Okay, so less about the pot of gold then and more about being a strategic mastermind.
Exactly.
Got it.
Yeah.
So no more boring cash deals, right?
Right.
We're diving into the deep end with this one. And mastering these strategies, well, it could be your ticket to some seriously impressive deals. So to kick things off, we're talking leverage buyouts, LBOs.
Yeah.
Imagine you're eyeing a fantastic house, but your bank account says, not so fast. You could get a mortgage, right?
Exactly. LBOs are essentially mortgages for companies.
Right.
For example, back in 1988, Kohlberg Kravis Roberts, or KKR.
KKR.
Yeah, they famously used an LBO to acquire RJR Nabisco.
Wow.
They used a small amount of their own money, a whole lot of borrowed funds, basically leveraging the target company's assets to secure the deal.
Okay.
This massive acquisition, worth over $25 billion at the time, it really showcases the power of LBOs.
See, I knew it was more exciting than a mortgage.
Yeah.
But just like with a house, taking on a big loan, well, it comes with risks.
Oh, absolutely.
So while LBOs can be incredibly powerful tools for acquisitions, they require a deep understanding of the company you're eyeing, their market position, and a whole lot of planning.
Definitely. That's why due diligence is critical with LBOs.
Yeah.
You need to be absolutely certain about the company's financial health and their future prospects before taking on that much debt.
Makes sense. You don't want to buy a house with a leaky roof.
Exactly.
So LBOs are all about leveraging debt to make that big purchase. But what if you want a more collaborative approach? Something where both the buyer and seller have some skin in the game.
Well, that's where seller financing comes in.
So we're moving from a high-stakes poker game to a friendly chess match.
You could say that?
Okay.
So instead of securing funding from, say, a bank or a third party,
Right.
the buyer gets a loan directly from the seller as part of the deal.
Oh.
This can be a win-win.
I like the sound of that.
The seller gets a steady income stream, and the buyer, well, they get a little bit of breathing room, financially speaking.
Yeah, I can see how that would build trust.
Right.
It's like the seller is saying, I believe in this deal so much, I'm willing to finance it myself.
Exactly. Take a small business, for example.
Okay.
A bakery wants to sell, but the interested buyer, they can't secure traditional financing.
Yeah.
The seller, they're confident in the bakery's success. They might offer financing.
Makes sense.
This ensures a smooth transition and a continued revenue stream.
It's like they're invested in your success.
Exactly.
But I'm guessing not all sellers are open to this?
You're right. Vetting the seller's motivation and their business's financial health is crucial in any acquisition, especially with seller financing. You need to be sure their interests align with yours.
So trust but verify.
Exactly.
Okay, so we've got LBOs for the bold and seller financing for the collaborative. What's next?
Let's talk earnouts. Think of them like performance bonuses for businesses.
Performance bonuses for businesses. Okay, now we're talking my language.
Right.
I love a good incentive program, so tell me more about this.
Well, with an earnout agreement, part of the purchase price is dependent on the acquired business hitting certain targets, after the acquisition.
Okay.
It's a way to incentivize performance and ensure everyone's invested in the outcome.
So it's like a built-in accountability system. The seller's motivated to ensure a smooth transition and continued growth because their final payout depends on it. And the buyer, well, they're protected from overpaying if the business doesn't meet expectations, right?
Reciprocally, it's a way to share both the risk and the reward.
Okay.
Imagine a tech startup, for instance,
Okay.
being acquired for their innovative software.
Right.
An earnout agreement could be structured around user growth or revenue targets.
Okay.
If the software hits those targets, boom, the seller receives additional compensation.
Oh, I like that.
It's a win-win that encourages collaboration and long-term success.
This is making me think about like all those Shark Tank deals
Right.
where they negotiate equity and royalties based on future performance.
Yes.
It's like a sophisticated real-world version of that.
Absolutely.
But that brings up a question, like, how do you actually measure performance in these agreements?
Yeah.
You can't just base it on a gut feeling, right?
You're exactly right. Defining performance is crucial, and this is where things can get tricky.
Yeah.
Is it revenue? Is it profitability?
Right.
User engagement?
Right.
Something else entirely.
Yeah.
It has to be crystal clear in the agreement.
Yeah. It's like setting KPIs for a marketing campaign. You don't just say, like, make the brand popular.
Exactly.
You
Well,
define what popular means, right?
yes.
Website traffic, social media engagement, things that you can actually track.
Right.
Otherwise, you're setting yourself up for potential disputes down the line.
Absolutely. Thorough due diligence,
Mm-hmm.
understanding those industry benchmarks, even seeking legal advice. These are all part of the process.
So with earnouts, it's all about aligning incentives, setting clear expectations from the get-go.
Yep.
We've covered LBOs, seller financing, earnouts. I'm feeling like quite the deal maker here.
I bet you are.
But we've got one more strategy to explore, and it sounds like a big one: equity swaps.
Okay.
It's almost like trading cards, but instead of baseball stars, we're talking about ownership stakes in entire companies.
That's a great way to put it, yeah.
right.
While the analogy is simple, equity swaps are anything but.
Okay.
They're a powerful tool, especially for mergers and acquisitions, where companies see a synergistic fit, meaning they believe that the combined entity will be much more valuable than the sum of its parts.
So instead of a straightforward acquisition, it's more like a strategic partnership,
Exactly.
where both companies maintain a vested interest in each other's success.
Right.
I can see how that could be beneficial in industries that are constantly evolving, ripe for disruption.
You're thinking along the right lines.
Okay.
Take, for example, the tech industry.
Sure.
Two companies might decide to merge through an equity swap, right, instead of one simply acquiring the other.
Right.
This way, they combine their expertise, their resources, their market share,
Okay.
and they create a much more, competitive force in the market.
So it's about joining forces to become a powerhouse.
Exactly.
And I'm assuming there might be some tax advantages to this kind of arrangement?
You would be right. There are.
Okay.
However, navigating the tax implications of an equity swap requires careful consideration
Of course.
and often expert advice.
Okay, so we've gone from LBOs leveraging debt like titans
Right.
to practically becoming business besties with equity swaps.
Right.
That's quite the range. What's the main takeaway for our listeners? Like, what's the thing that connects all of these creative financing strategies?
I think the main takeaway is you got to think outside the box.
Okay.
Creative financing, it's not just about the money.
Right.
It's about structuring deals that work for everyone. It's about finding those win-win situations where the buyer and the seller both win.
So it's like the difference between like a transactional handshake
Yes.
and the start of like a powerful alliance.
Exactly. And that brings up another important point.
Okay.
Securing the deal. No matter how innovative the financing is, it's just the first step.
Right, because there's that saying, right? Buying a business is easy, running one, that's hard. So what advice would you give to our listeners who are navigating that post-acquisition world? Like, how do you ensure that smooth transition and, a successful integration?
I think communication is key.
Oh, okay.
You're bringing together different teams, different cultures, different ways of doing things.
Of course.
It takes time, it takes sensitivity, and it takes a lot of open dialogue.
Right.
Remember, you're acquiring people.
Yes.
You're acquiring talent, expertise. You're not just acquiring, numbers on a balance sheet.
It's about the people.
Exactly.
Yeah.
Nurturing those relationships is just as important as, crunching the numbers.
So true. It's about combining the best of both worlds
Exactly.
to create something even stronger.
Yeah.
This has been such an insightful deep dive.
Yeah.
I feel like I've graduated from Financing 101 to, like, the masterclass in deal making.
There you go.
Any final thoughts before we wrap things up?
Yeah, in today's market, where everyone's vying for that same prize,
Right.
mastering creative financing, it could be your secret weapon.
Okay.
It could be your ticket to unlocking those deals, that seem impossible.
Right. The hidden gems.
Yeah, exactly.
Yeah.
And solidifying your place as, a strategic investor.
It's like having that extra gear
Yes.
that lets you pull ahead of the pack.
Exactly.
I love it.
There you go.
Well, for our listeners who want to learn even more, be sure to check out MD White's full article.
Please do.
We'll include a link in the show notes. And thanks for joining us on this deep dive. Until next time, stay curious, stay informed, and keep reaching for those next level opportunities.
Sounds good.